Welcome, and thank you for joining us today for our presentation on U.S. expansion through acquisition, Part 2, Finding Your Target Company. I'm Carolyn Powell, Business Development Director here at Tronconi, Seguer & Associates, and I'll be your host today. If you listened to Part 1 of this series, you heard our experts present to us things to think about when considering a U.S. acquisition. From the basic questions of how long will the process take and what is involved with acquiring a target business, to what are the best practices for a Canadian-owned company to have a U.S. operation and revenues. Building off that presentation, today I'm joined by Mark Firm and Alan Pulowski to talk further about considerations when looking at an acquisition opportunity in the U.S. Mark and Alan will cover the high-level points of finding your target company, giving you what you really need to know to get started. We'll leave time at the end for Q&A. Feel free to type questions in the question box in the sidebar during the presentation, and we'll get them answered at the end. We will also provide Mark and Alan's full contact information at the end of the presentation if you'd like to follow up with them directly. Later today, I'll send you a copy of the presentation and a link to the recorded version if you'd like to view it again or share it with a colleague. You will also find a copy of today's presentation in the handout section of the sidebar. So without further ado, let's get started. Mark Firm is a partner here at Tronconi, Seguer & Associates. Tronconi, Seguer & Associates is a full-service accounting firm whose mission is to provide the best and most appropriate and professional accounting, auditing, and tax consulting services in the industry. Mark has over 25 years of accounting and audit experience and has expertise in transaction advisory services, including buy-side and sell-side and due diligence procedures. Alan Pulowski joins us from NextPoint. NextPoint is a business consulting company that helps business owners restructure a business to restructure, grow, or sell. The majority of their clients are closely held manufacturing and distribution companies between 1 and 50 million. Alan has over 20 years experience in the business improvement, turnarounds, and acquisition strategies. Mark, do you want to get us started today?
Sure, thanks, Carolyn. I appreciate everybody attending again as a follow-up to our webinar that we had back in November of 2020. It was a great session. We talked a lot about the financial and tax and finance considerations in moving into the U.S. through acquisition primarily from Canada, but a lot of those concepts really apply in any sort of cross-border transactions coming into the U.S. But our focus being on Canada. Seeing the audience list, did see most of the participants being from Canada, so welcome everybody, and looking forward to getting back to visit Canada when the borders open. I do enjoy playing golf up there and visiting our neighbors, so looking forward to that. But welcome everybody. So what I wanted to start with is sort of a recap of our webinar from November 2020. Because again, we covered a lot of more sort of detailed accounting and tax and finance matters. And the feedback we got was this is a lot of great detailed information, but want to know a little bit more about now how to execute an acquisition, how to look for potential targets. And so that's why I'm pleased to have Alan here today, because that's, he has an expertise in that area. And together we're going to kind of link our previous webinar to kind of what the request was, which is to learn more about the how. And for those that weren't able to attend the last seminar, it is posted on our YouTube page. So feel free to go back and listen to that for any details. But what I want to do is just cover some of those highlights and kind of point out where there's some connectivity to or more areas that are unique to cross-border transactions, as well as make the link to our topic for today, which is the how. So just in summary, some of the areas we talked about is making initial contact and discussion with a potential seller. And a lot of that purpose of that is to meet with the owners, meet with management, to understand the business, collect some information, understand where the business has been, understand the industry and where it's going. And that information can be used really as a basis to assess the target as an acquisition candidate. And some of the things to think through there as you're gathering that information is valuation and structure. How much do you think the business is worth, and how much are you willing to pay for it? What is going to be the structure of the transaction? Is it going to be an asset deal or a stock deal? And I won't get into all the details again. It was covered in a lot of detail in our previous webinar. But the structure can make a really big difference, particularly for tax purposes. And it becomes even more important to assess the structure if you do a cross-border deal and understand the implications of tax over here in the US, tax in Canada, how the treaty works, and all those different implications. So really important to make those assessments early on, to then the ultimate objective after understanding what the valuation is and potential structure is then to define what I call the magic. What is the magic of that business? What really makes it tick? What makes it valuable? And ensuring that whatever that magic is, you're going to be able to acquire it. Otherwise, the business isn't worth anything. Now, later on in our presentation, we're going to talk about what Alan calls the why. Why am I doing an acquisition? Why do I want to grow by acquisition into the U.S.? Kind of similar concept, a little bit different, but we're going to share a sort of a horror story as it relates to that. And so again, making sure that understanding why you want to do an acquisition and ensure that whatever target that you choose or targets that you choose fits that why or fits that objective. So ultimately then would lead to a proposal or indication of interest to the seller, and we're executing a letter of intent, really ultimately a letter of intent, which outlines the assumptions as well as significant terms and conditions that the parties anticipate to enter into when they close the transaction. So it's really that ultimate letter of intent that's important. All of those have unique cross-border aspects. So in confirmatory due diligence, we talked a lot about that in our previous webinar, and mainly focused on financial due diligence, tax due diligence, and we covered a little business and operational due diligence. But later on, when we talk about the how, we're going to talk about how important that aspect is. Because I think what we find in an acquisition is a business owner or a shareholder or somebody will identify a target, and their first call is to the CFO or to the attorney or both and say, hey, we're looking at an acquisition, execute. And so the attorneys and CFOs do a very good job on the financial, tax, and legal matters, but many times forget the operational due diligence. And we're going to talk about, again, a case study there in which there were some significant issues related to not the lack of operational due diligence. But just in summary, what we talked about in our last webinar, financial diligence, some highlights there to focus on, looking at earnings, or what we'll call EBITDA, earnings before interest, taxes, depreciation, and amortization. And what does historical EBITDA look like? Most folks would value business based on either value of assets and or cash flow, which is measured by EBITDA, typically. And look at how sustainable EBITDA is. Are there any non-recurring expenses or income reflected in historical EBITDA? Where is projected EBITDA going? Because not only does that help inform the buyer about valuation, but it'll also help to determine how you can structure it and how much debt you can borrow to finance the acquisition. Working capital is part of the valuation of business, is the delivery of working capital. And that's important to understand the components of that, how much collateral you may have, and does the working capital support the valuation assigned to that business? And then looking for contingencies, any contingent liabilities, whether environmental liabilities or anything else. So those are kind of highlights. There's a lot more to financial diligence, but those are some of the more key highlights that we take a look at. On the tax side, looking for significant exposures. One of the things that we find in cross-border deals that is new to many many folks coming into the US, particularly Canada, that they may not have touched on before if they're not doing business in the US yet, is sales and use tax. So sales and use tax for products sold in the US, the tax that's levied on that. And that's a very emerging, very complex area here in the States. And it's different than VAT, it's not the same thing. And so one of the SALT is what I call a hidden tax. Many people don't pay attention to it, and that can become a real exposure on an acquisition. So if you're working on a particular acquisition strategy or a target, please ask whoever your team is, make sure that they're looking at sales and use tax. That almost always is an issue in looking at a US domestic acquisition. A couple other key areas in the tax area to focus in on are unfiled taxes, making sure the company has filed appropriate taxes. Usually it's not a problem for federal, but we have 51 different jurisdictions, 50 states and Puerto Rico to worry about here. And so each of those states have their own state income tax compliance requirements. And so it's important to understand that if you're doing business there, that you have to file appropriate taxes there. And then lastly, just wanted to mention any pending tax audits. So the company is being audited by a state tax authority or the IRS, that you take a look at those pending tax audits to see if there's any contingencies. So we'll talk a little bit more again about business operation due diligence later on. Hugely important and probably one of the most missed areas in diligence. So just to cover a couple of the areas we talked about in November, preparation of deal documentation. Before I get into this, and this is where attorneys typically get involved quite a bit in this area. But what I want to mention today is what I'm finding is in working with your team, if you're looking at an acquisition, is the buyer and the seller developing expectations on timeline, as well as sort of rules of engagement for the accountants and attorneys, such that there is an expectation towards how many terms of the document, if you will. Because I think what we find in acquisitions, I know there's some attorneys on the call today, and they probably experience this as well, is way too many terms of the document, and sort of the accountants and attorneys, fighting about words and fighting about terms and conditions. We all know that we all have our jobs to do to support our clients, as well as to protect their interests. But also it gets to a point where the principals to the transaction have to just get to a point where they agree and come up with some agreeable terms that make sense for both sides. So with that said, I mean, some of the key documentation to close a transaction, of course, the purchase agreement itself. Non-compete agreements. It's important to note any selling shareholders or other key people that if they're going to be sort of flying the coop, if you will, after the deal closes, we don't want them setting up a competing business. So non-compete agreements, that's pretty straightforward. Employment agreements for key employees, particularly for small, medium-sized business, family-owned businesses. Many times they will not have employment agreements. So it's important to understand who those key people are and what types of agreements can we put in place to ensure that, particularly if they're key people and they're part of this magic, as I call it, that we were able to employ them going forward, understand what the terms of their employment are. And then lastly, finance agreements. And this, as a buyer, this is something you'll primarily be working with your bank, but something that don't allow this to sneak up on you because you're so focused on working with the seller on those appropriate agreements with them. You also have to obviously complete the financing agreements. And there are certain things that can kind of sneak up on you. So, example, if there's an environmental liability, you may need to have an environmental study done that might hold up financing. So just thinking that through in advance would be helpful. So in closing and post-closing activities, I really want to focus on just post-closing activities. A couple things to consider is, and one of the things that I find is forgotten about, that we're going to talk a little bit more about in the how, is transition plan and integration. That, if you, in my opinion, once you sign a letter of intent, you should have your team, whoever that team might be, starting to think about integration and transition. What are the things, and it's not just about accounting and tax, it's human resources, it's information technology, operations, and if you're doing a cross-border deal, logistics. Right now, most importantly, during this pandemic, we can't get across the border. Very difficult to get across the border. So looking through some of those logistics and importing and moving goods, between borders. So that transition plan, integration plan, I kind of talk about it in this post-closing activity sort of section. But if you close a deal and if you haven't started your integration plan, you're definitely behind the 8 ball. So start that as early on as possible. Working capital verification. It's going to be important to, as closing a deal, understand what kind of working capital he actually was delivered by the seller. Understanding any special tax filings. There's many different tax jurisdictions here in the U.S. Depending where your assets are, where the operations are, you may have to file certain notifications with state tax authorities. And then lastly, finalization of the opening balance sheet, which is particularly important for tax purposes. Depending on the structure, the way that you allocate the purchase price can make a big difference for tax planning. So that's sort of the summary of our webinar in 2020, or in November of 2020. And I guess what I'd like to do is maybe turn it over to Alan to kind of kick us off on sort of our topics for the remainder of our session here today.
Thanks, Mark. First, I'd like to thank Mark and Carolyn and Tronconi Segura for having me participate in this webinar. It's a pleasure to work with you folks. And thank all of the attendees also for taking their lunch hour here to spend some time with us and learn a little bit about the incredibly exciting topic of mergers and acquisitions. Today, we're going to talk about, as Mark mentioned, the how on how to execute an acquisition cross-border. And again, as Mark mentioned, many of these topics are cross-border agnostic. They apply for cross-border and just general mergers and acquisitions in general, but very hot topics and fundamental topics that we thought would be really well presented and well received for the fundamentals of acquisition. So today we're going to talk about before we talk about the how, we want to talk about the why. Knowing your why. Why are you entertaining this? Why are you contemplating this? What's the reasons behind doing this, and sort of vetting those reasons, and making sure that a lot of this makes sense in alignment with whatever your macro strategies are with your business. After we sort of sort out in everybody's mind the why, then we start talking about, is your business acquisition ready? You don't build a house before you build a foundation. You should not buy a business before you are ready to buy a business. And we'll talk about some of the operational and financial principles that support acquisition readiness. After we talk about the why and the readiness, we'll talk about the actual how. Probably the reason most of you are attending today, to see some of the behind the scene processes of actually finding multiple targets to do an acquisition. The ideal process produces more than one appealing target that puts the buyer in a position of advantage, and we'll talk about that extensively. And lastly, about the acquisition team, the importance of that, and some things just to be aware of going into something like this. Surround yourself with people that know this process well.
Yeah, Alan, if I could just jump in here a second too. As Alan had mentioned, the how, or how we do an acquisition, is relatively agnostic, right? Usually regardless of where you're doing it, or even cross-border. But I think what we'll do today is maybe try to point out a few areas that are unique to, if you're coming in from Canada, maybe some things that to be aware of as doing business in the US. If you haven't done an acquisition before or haven't done business here, we'll try to point out some of those little nuances here that might matter for the audience today.
Perfect. So let's start with some vocabulary. Some of you may know this stuff, and I won't take a bunch of time on this, but it's good to understand the differences when you talk about a financial buyer versus a strategic buyer, and then categorize yourselves as one or the other. A financial buyer, if I was to go to buy a business in an industry that I don't participate in, I'm looking for a return on investment, that business is going to be appealing to me, but the valuation and and the reason for buying it are purely economic. A strategic buyer is somebody that potentially participates in an industry, and the acquisition has some kind of horizontal or vertical integration to what they do on a day-to-day basis. We're in a financial situation, 1 + 1 is going to equal 2 from an economics point of view. In a strategic situation, if I buy a business for its customer list and I can now cross-sell to both customer lists, the acquisition 1 + 1 could easily equal 2.5 or 3, giving you the ability potentially to be more aggressive in your offer and your pricing model. So when you're looking at buying a business, sort of decide to yourself, am I a financial buyer or a strategic buyer? And the principles that you'll follow are roughly the same, but what you're willing to pay might change dramatically. And one of the principles of payment is EBITDA, or valuation is EBITDA. And Mark's going to expound on that here.
Yeah, so, EBITDA, I mentioned this before, some it's, at the face of it is relatively straightforward. Earnings before interest, taxes, depreciation, and amortization. Those in business, it's a pretty, common measure. And but in an acquisition sense, we like to say normalized EBITDA. Well, what is normalized EBITDA? And again, those that may have done acquisitions before are very accustomed to this. But those that haven't, normalized EBITDA is, okay, we know what historical EBITDA is, but are there one-time expenses or income that aren't going to recur? If they're not going to recur, we want to understand what those are and sort of add or subtract those from historical EBITDA. Understand, okay, where have we been on a recurring normalized quote EBITDA basis? There could also be, especially in small businesses, which is probably a predominant small to medium-sized business, a predominant portion of our practice as well as Alan's, owner expenses. So in a family-owned business, you have owners that may have certain personal expenses running through the business. Could be cars, family members that work in the business or don't work in the business that are still getting paid. Could be just other personal expenses that are running through. So if that's the case, me as a buyer, I'm likely not going to have those expenses recur after I acquire the business. So those are add backs to EBITDA. It actually improves my EBITDA position. And then I want to provide sort of an example, and then I'll touch on an example. Again, if you haven't done a US deal before, another EBITDA adjustment associated with a cross-border deal. But one example I want to give is, so we're working on a deal right now where the target, we're on the buy side, and the target lost a major customer, and with pretty healthy margins. And so what we're doing is sort of normalizing historical EBITDA for now. Well, now we know there's customers not going to be there anymore. What's the revenue and margin impact? And so now I know my EBITDA on a recurring basis is going to be lower because of that lost customer. The one area, as I mentioned, the hidden tax, the sales and use tax. So what we find in acquisitions, you might say, okay, well, let's just correct the problem. If they haven't been paying sales and use tax for a period of time, we'll just file sales and use tax going forward. But you have carryover liability, and then also, if you had charged sales tax all along, are you able to pass that through to your customer or not? If you can't pass, and this is, again, I wanted to highlight this because if you haven't been in the US before, this can be a significant impact to EBITDA. If you can't pass that through to your customer and still be competitive, that's a direct impact to EBITDA. If you can pass it through and still be price competitive, then it's likely not going to be an impact to EBITDA. So I just wanted to kind of highlight that as something like a cross-border thing to take a look at. So understanding why, I think, Al, I know you're going to maybe kick us off here, and I have an example here as well.
Perfect. Thanks, Mark. So back to understanding your why on a cross-border related interest. Is it a U.S. address that's appealing to the buying company from a strategic point of view? Is it a U.S. distribution network from the sell side? Is it U.S. cost of goods from the cost of goods side? What is your strategy? Why do you want to go through the acquisition process? Defining your why is a critical first step to an acquisition process. More generic reasons for an acquisition: are you trying to build critical mass on the buy side company to drive value in your company for either greater profitability or maybe you want to hit a certain EBITDA figure to build critical mass where you become appealing to a private equity group or some larger consolidated type of buying entities. Mark, I think you have an excellent example talking about whys.
Yeah, so we had a client we were working with in the past, several years ago, that, they had a lot of, they were outsourcing some machined parts to various machine companies. Probably had 4 or 5 machine companies that they were working with. One in particular they liked, good management team, good solid company. And they thought internally, hey, why don't we acquire this business and we can bring all the machining in-house. It's like, wow, it's a great idea. Good solid company. The diligence was pretty straightforward. Not a complex business, closed the deal pretty efficiently. It was a smaller acquisition for this company. But what they found out is after they closed, they really didn't focus on the business due diligence, operations due diligence. And after they closed, the operations team said, hey, just FYI, many of the machines that are here can't machine a lot of the parts that we need. They can machine the parts that they machine for us, but everything else that we were trying to decide to do internally, we really can't execute the why. We wanted to buy this company so we could do all our machining in-house. Well, it didn't fit the objective. So the investment thesis just kind of blew up. Did it cash flow? Sure, it cash flowed, but it wasn't accretive like they had anticipated because they didn't meet the objective or the why in this case.
So the other why, everybody's doing it. I wanted to mention today some statistics that we pulled out of Q1 American Mergers and Acquisitions Association statistics. Mergers and acquisitions on the buy side, people buying other businesses, is up 50%. It went from 31% of M&A houses to 48% of M&A houses focusing on buy side activities. Sell side activities. Therefore, providing a lot more targets for people that are interested in buying. The sell side of the world has exploded. There are incredible amounts of opportunities. We're finding many times due to an existing baby boomer aging out society, we're seeing a lot of activity there. But interestingly, post-COVID, we're seeing a lot of fatigue out. People are just saying that we're going to finish, we're going to leave the party a bit earlier. We're just tired at this point in time. And the statistics support everybody is doing it. One other side note on the buy side is that private equities have had to go on the shelf for a year from an investment point of view, and they are being very aggressive in the private market in smaller and smaller companies. So the sell side the buy side is up as well, buyer beware, but there are a lot of targets to be had if you're looking to acquire another business.
Yeah, so I think to sort of tag on to what Alan is talking about here, valuations are high, and there's a lot of cash running around trying to find deals, and even though there's a lot of deals out there, as we all know, trying to find the right fit, takes some time. So, but as Alan mentioned, with the baby boomers wanting to retire, retired owners, lots of cash valuations, it's a recipe. It's a good recipe for a frothy deal market. The other thing I think we're finding here in the U.S. For those for our Canadian guests is that there was a change in the Oval Office, the White House, and there's been a lot of discussion, a lot of saber rattling from Joe Biden about changing the tax code and what that might mean, particularly for capital gains rates here in the U.S. And so there's a lot of anxious business owners. If they're at the precipice of potentially selling, then there may be even more at the precipice because of uncertainty on the tax code. But so then conversely on the buy side, it's sort of important to sort of track that tax, pending tax law changes as it might impact how you view particular targets. With that said, what we're telling our clients, buy side and sell side, no one knows what's going to happen with the tax code. It's impossible. If I knew what was going to happen with the tax code, I probably wouldn't be here. But but I also tell clients, don't let the tax tail wag the dog, right? Because we just have no idea. I mean, early indications are The president doesn't seem to have a lot of support, enough support in the Senate to make maybe some of the more significant changes. Now watch this, as soon as I say it, there'll be a press release that says he's got Senate support. But, theory being, or the theme being is, build out a good acquisition strategy, well thought out, think of your why, think about the strategic reasons why you want to do that strategy, make well-informed decisions the best you can based on tax code, current tax code, and informed based on what you think is going to happen. But don't let that make your decision, I guess is really the thing. So,
Mark, I couldn't agree more. That's a great piece of advice. But to dovetail off that, I am seeing a ton of my sell side clients raising their sense of urgency and anticipation of some tax law changes, again, exacerbating the amount of potential targets that may be available stateside. So shifting gears to, are you and your company acquisition ready? You need to look at your culture, the culture of your business predominantly. If you are a Warren Buffett company that you are 9 to 5, you round every invoice to the penny, and it is a very structured, regimented environment, and you're looking at buying something that looks more like Google, those two cultures will never align. And if those two businesses made sense financially on paper, the lack of alignment with culture will be the ultimate end of the idea. So when we start discussions, buy or sell side, it always starts with culture, employee-centric, customer-centric, whatever those cultural drivers are. That is first and foremost with these topics.
and source of financing, I think, will lead it to that point. It's important to understand, I think the acquirers who are ready with an acquisition strategy and a sort of a financing model is a huge benefit. As we can see it from, in representing sellers as an example, that the more confident a seller can be in a buyer's ability to close the deal is hugely important. And they will pick a lower purchase price at times to get confidence that you can close the deal. So in advance, theme being as a buyer, being prepared to understand how you're going to finance the deal. Is it going to be traditional debt? Do you need to raise some capital? Do you have excess cash available to throw into the deal? And this becomes, the reason I really wanted to hone in on this, is becomes more important as a cross-border buyer to talk to your banks in advance, understand, okay, we're going to be exploring an acquisition strategy, start to understand what their capabilities are, what their willingness is to lend on cross-border deals. Also, where are they going to lend to? Is it going to be a US bound debt instrument, a Canadian-based debt instrument? And understand how that impacts the tax structure, as well as cash flow. So having those thoughts kind of in advance with your team and your bank partner is going to be hugely important. Some folks might be using local banks, and maybe for international acquisitions, it's maybe talking to some other banks to kind of understand what their capabilities are in that arena. So the more prepared you are and the ability, and I know, Alan, you can probably attest to it, representing sellers, it's, if you have that sort of financing structure in place, you have a greater probability of closing a transaction.
Totally agree. And many times in LOIs, we like to represent, when we're doing buy side, what the source of financing is, giving the seller the confidence that this is a good buyer, much like getting pre-qualified when you're buying a home. You just want to have as much as you can, your ducks in a row from the finance side. I completely agree. Systems and process are incredibly important. Back to the foundation and home building analogy. I want to place this metaphor in your mind. If somebody comes into if you acquire a business and you've got a team of 5 salespeople that's going to integrate to your team of 15 salespeople, you want to bring them in for your training, tell them what your systems and process look like. And globally around your company, you want to be able to say, this is the way my company does this. If you can't clearly articulate the key systems and process for all the major workflow functions of your business, you need to polish up the systems and prospects as aspects of your business. Because when you start trying to train these newly acquired employees and the new customers and all this integration process, and you're not well defined in your systems and process, things start, cracks become crevices, become valleys. Very dangerous part. Having your people ready for the process as well. Unfortunately, many times people get into traditional size and scopes of work kind of ruts. The addition of another company, minor or major, can impact your people's perception, perspectives, and potentially retention of, which is a critical issue. Many times our biggest assets aren't on our balance sheet, they're the people of the business itself. And I'd say that anybody going to listen, the differentiators going forward in the next decades and century will be customer service and technology. So if you don't have some kind of a technology platform that you're working from, a basic CRM or a more enhanced ERP to integrate the next company into, you might want to consider looking at your technology base as well. Once we've gone through all the foundational stuff, defining a target becomes the next step in the process. You ought to think to yourself, what would an ideal target be? What would you look at? Many times, more importantly, what would you not look at? Because ideally, you want to be searching for something that aligns with your why. We defined the why we're going to do it earlier. Now we're saying, what would align with our why? And in this part of the process, I always believe it's best to sit down and put pen to paper and sort of create a spec sheet for what is ideal. What would you look at that's not quite ideal, but yes, you would look at. And again, more importantly, what would you not look at? With a spec sheet, you can quickly start looking through multiple targets and opportunities and saying in or out, making the process far more efficient. You can get mired down, waste a lot of time, waste a lot of money, chasing non-opportunities, absent these kind of constraints, controls, and preparation.
Well, I think what, Al, maybe you could shed some light on, I think one of the things that would help with, if you're going to be an active buyer, you start to talk to sort of a group of analysts around, right?
Mm-hmm.
That, guys that are representing sellers. And if they know your target, the types of target, they're not just going to shoot over stuff to you that doesn't make sense, right?
Right.
So
Exactly.
It's a time saver.
Absolutely.
Right? They'll get to know you. So
it's definitely far more efficient. You also, during this whole process, still have to operate your business, right? This is a bolt-on from a time, attention, and focus to every business owner or management team that's in charge of acquisition. So you want to make this as efficient as possible. You don't want to be wasting your time. It is a big distraction. So continuing on definition of targets and examples of what to look at. Are you trying to grow your top line in revenue? Is your business people-based? You can generate more leads and revenue with additional people. Are you trying to get into different states, provinces, or a geographic reach? When you're looking at a target, do you want to buy 100% of the business? Controlling interest, minority position, right? Those are interesting things to look at when you're talking about the acquisition of a business. Is it some now, more later? What is the timing of these kinds of strategies? Is your business a flip strategy? Are you trying to buy a business to increase the size of your business to eventually flip in 3 to 5 years? Understanding the why, backing up again, and then helping define the targets are incredibly interrelated.
yeah.
Mark, would you mind talking a little bit more about financing a deal as a area of expert?
Yeah, this is part of the, developing a strategy and the how of doing acquisition. Again, we always recommend that it's someone particularly new to the acquisition area or arena, and it becomes more important in a cross-border sense because of the sort of the intricacies that we talked about with U.S. banks, is to understand what your finance model is going to look like. How much cash do you have available? Do you have a bank that's ready to finance a deal? And so I just wanted to kind of walk through just a very high level example. It's an example only. Every deal is different. Every bank's different. So I just want to kind of highlight, because many times I've been, we've been engaged by a buyer to help them with sort of structuring a deal and financing. And all too often we get to a point where it hasn't been really well thought through, and they have an opportunity on their doorstep, and they really can't execute because they don't have really the financing figured out. And so when they approach, you know, a seller with, you know, well, we're not certain yet as to what our financing structure is going to look like. Again, that puts uncertainty in from the seller's perspective, and may go to another buyer. So it's really thinking through, really, how much can I afford and how much cash do I need? And so again, just high level example, let's just say for a moment, you found a business that had 5 million in EBITDA. And again, just for sake of discussion, the multiple you're going to pay 6 times or 30 million of enterprise value. Let's just say for a moment, based on EBITDA and collateral of the business, that a bank, say they were going to look to maybe lend 20 million on that deal. You have a $10 million delta. Or even if they're looking to maybe lend you a little bit more than that. So you always got to think about, okay, what is a bank willing to lend? Again, each bank is different in terms of their underwriting standards and things of that nature. So developing that relationship with the bank is important to say, okay, given our why, given our target base, here's the size we're looking for. How might you structure the terms of a loan, so that then we can then back into how much more cash do we need, either through cash that we already have, or are there other tools we need to use, such as a seller's note or an earnout. Now, I will tell you, and Alan, you probably experienced this, sellers don't like seller notes.
That's for sure.
And an earnout being like, we only pay them if the business performs in the future. Again, that creates uncertainty, and sellers typically don't like that. The more cash at closing, the better if you're an eager buyer. But it's understanding that the financing in advance, so you know how much money you need to close the deal.
One comment on financing, Mark. I want everybody to be aware that you don't necessarily need a lot of money to buy a business. I seem to find a lot of people I talk to that want to buy a business, they've sorted out their why, the strategy, and how it makes sense, but they're dissuaded by, I really need a lot of money to buy a business. Mark said it perfectly. All deals are different. Some do require a lot of capital at closing, but some I've done require little or no money at closing. But sorting out your why, the strategy, all these details we've talked about in the past, don't not do this because you think you need a lot of money. Each deal is different. And I would also suggest, Mark said this, shop banks. You have an existing bank, probably get quotes from 1 or 2 or 3 banks when you're looking to do acquisitions, because the structures can vary dramatically, changing the amount of money you need personally to come up with to do this closing. So great stuff. Thank you. Thank you. So an interesting point that I'd like to bring up also is prices, obviously, to all of us, incredibly important in most everything we do. But when looking at a business acquisition, I always say that the price is in the top 5 most important aspects, but it's not in the top 3. I just want to go over many times will become the most important aspects on the buy side for acquisition. As I mentioned earlier, cultural alignment is absolutely number 1 when you're talking an acquisition to mitigate risk for integration of the 2 companies and success moving forward. To eventually monetize your strategic vision, enjoy the accretive dollars of the merge of the 2 companies, and ride off into the sunset and do it all over again. Secondly is the strategic alignment, really understanding, again, back to that why are we putting these 2 together? Where are the synergies and the strategies? Are they well defined and vetted out? And third, which I always want to emphasize, is more important than price is structure. If you have a $30 million business like Mark talked about before, and I'm going to come and offer you cash at closing, maybe the seller will take $28 million if I give him 100 cents on a dollar at closing. If I try to push of that $30 million business, half of it on seller paper, Mark said, and I agree, sellers don't like paper, that price might go up to $33 or $35 million. So the price starts getting pushed around based on the differing structures you can present to the sellers. So culture, strategic alignment, and then very importantly, what the structure ends up looking like. So let's talk about the actual process now. There's the mechanics of we start reaching out to targets that align with your spec sheet, your vision, your why, your strategy. In our world, we try to get emails, letters, calls in the M&A process to targets that are defined to fit your spec sheet. The math is we start with a list of about 300 plus or minus targets that fit your spec sheet, which ends up converting into about 30 conversations, which ends up converting to about 5 meaningful conversations. And many times we can submit 3 pre-due diligence LOIs and then hopefully 1 purchase. It's that easy, right? It really becomes almost like a sales funnel or a conversion metric, where if we define our why, define our strategy, craft a list of targets from the buy side that fulfill both of those, you weed out the non-cultural alignments, the non-strategic alignments, and the 300 is our sweet spot from a statistical, historic point of view to do an acquisition.
And so, Alan, I know we were talking about this the other day about in preparing for this, that, you know, how many deals do you see, you know, you go through all this work, right? And you get to the altar, how many deals fail, right? For one reason or another.
Yeah.
I mean, it's a relatively higher percentage than you would.
I don't know. Post LOI, probably a third.
Yeah.
That's my intuitive guess. I don't have a hard stat on that.
Yeah.
What would you say?
You know, I'd probably post LOI, you know, yeah, probably a third. I mean, as you get closer to closing, you know, that percentage goes down, but you think about all this work that you got to go through to find a target and,
Yeah.
you know, do all the work. And sometimes it just doesn't work out.
Correct.
So.
Just because the LOI has been submitted doesn't mean you're going to cross the finish line. Again, sort of like a house closing.
So, you know, as we talked about earlier, kind of early part, and just to sort of recap on the acquisition team, you know, one of the things that, as I mentioned, that, you know, a lot of times it lands in the lap of the CFO and an attorney, but it's important to bring together the team that's going to handle particularly the integration, post-integration, implementation of the acquisition. And that's, you know, working with your information technology team, human resources. We had talked, one of the top reasons that Alan talked about is culture, fit, and understanding what, you know, how it's going to work post-acquisition. And of course, you know, legal and accounting and tax, but remember the horror story we talked about, operations and business due diligence, understand. And as a cross-border deal is logistics. Like what it is, are you buying a distribution channel and you're shipping product from Canada into the US? So it's all the logistics that go along with moving that inventory, just as an example. So it's important to get all those pieces in place and have assignments and people accountable for different work streams so that you can have a successful close as well as integration.
Just want a quick comment. Some of the less popular or less common acquisition team members can easily be your insurance person. If you're looking for an acquisition, there may be some oddities in the target that you're looking at that require different insurance coverages. In cross-border, I would highly advise talking to a domestic insurance company about an acquisition, how it might differ from Canadian underwriting. You're an investment advisor. How much capital should you put at risk for an acquisition? Think very broad when you think about your acquisition team, past the traditional M&A great accountant like Mark, the lawyers that are out there in the world, and the traditional acquisition team. So let's recap what the key takeaways are from today. Knowing and understanding your why, thoroughly vet that. Are you acquisition ready? Go through the key points that we talked about. The how, it's simple, it's a process. It's a inverted sales funnel, and make sure you have good advisors on your acquisition team to help you through the entire process. Mitigating risk for execution and success in the future. Any questions?
So then, Carolyn, I think we had some questions posted, I believe, by some of the participants.
We did. We have a couple here. Thank you guys for the information that you shared. This was great for our listeners on everything they need to consider and think about and what's to do next. So if you haven't put a question in the question box, just go over to the sidebar, add to what we have in here, but we'll start with a couple questions. So first question, how long does it take to find and eventually purchase a business? How long? Is it a couple months? Is it a year?
Well, I'm kind of interested in Alan's perspective as well, but, and I did see, and thank you everybody for, filling out some of the pre-webinar questions. It was very helpful to understand our audience because, I did see a lot of respondents say that they were interested in doing a deal immediately or, as soon as possible. And so I don't know, I think it varies. I think most investment bankers will want it to be done in 30 days, but, it rarely is. I would say, it's probably a 6 to 12 month process. Well, really depends on, how far along you are in sort of the why identification, the targets, all that sort of outline, but it's probably longer. It's probably in that 6 to 12 month range.
Totally agree, Mark.
In that kind of sense.
6 is fast.
Yeah.
Things need to be well sorted for 6 to happen. But 6 to 12 to get something across the finish line. But it can take a lot longer. It can take years.
So I guess that kind of leads into the next question. What happens if the deal does not close?
Well, you have multiple options. In my example of the sales funnel numbers, if you had 3 targets that you liked, you chose one, you put an LOI together, somehow during due diligence, something didn't align and blew up on you, you can go back to the other 2 and then start the process all over again. But many times we want to take a look at why it didn't work out. Was it the buy side? Was it the sell side? Take some time to analyze why it didn't work out. But for the most part, you can reboot and do it all over again if you've got a couple extras in your quiver from the target acquisition process. Sometimes, rarely, people just take a break and we'll reboot at a different time. But for the most part, it's just a reboot and starting all over again.
Great. What are the biggest mistakes companies make when acquiring a company?
Well, that's tough, but I think one of the areas we talked about, just to sort of rehash a bit, non-financial areas, the operation side, the people side, the culture. I think that not paying attention to those areas, I find that as common misses. So whether it's a common mistake, yeah, probably a common mistake or the biggest mistake. And we talked about our example earlier. I'd say, I do find, particularly those coming into the U.S. for the first time, that I wanted to highlight I guess I could highlight for the cross-border group here is sales and use tax. I mean, it sounds kind of like, it's like boring, it can be boring stuff. But, at the end of the day, it's one of those, again, hidden taxes. No one pays attention to it until they need to. And so I think that's can be a big mistake.
I definitely have seen that in, even my past roles of working with Canadian companies. A Canadian was buying another Canadian with a location here in the US. And when they started to dig into the sales tax and the reporting, they really uncovered a little nest of mess.
Yeah.
And that all had to be cleaned up and kind of going back and forth. So you do this every day. I don't. And I do definitely still see it out there. So.
Well, just as an example, as an exposure, let's just say you have a company you're buying that's doing business in the state that it's not collecting or remitting sales tax. And the sales in that state, again, let's just use numbers here for a minute because easy math, they're doing $10 million of revenue in that state, right? And let's just say for a moment the sales tax is 7% in that particular state. You have a $700,000 exposure per year. And what happens is if you haven't filed correctly in that state, there's typically not a statute of limitations. So in theory, the state could go back as far as they want. Now, is that going to happen? Who knows? What's the likelihood of that? Who knows? But that exposure grows significantly and can carry with it also penalties and interest. So we have tools and things that we do to help us, we go through some voluntary disclosure agreements with some states to try to sort of lap off that liability. But if you don't pay attention to sales and use tax, it can really bite you. And then the response I sometimes get is, yeah, but Mark, we're doing an asset deal. It's clean. We're not inheriting any liabilities. But some states will actually put a lien on the assets that you bought and say, pony up the tax. And we don't care that it was the seller's problem. It's your problem. If you need the money back, go to the seller to get that back. So sales and use tax, and I'd say integration and transition plan would be probably the other one I could think of.
Great, thank you. One last question here, and let's see who wants to take this one. Will a strategic buyer pay a different price from a financial buyer?
I'll jump on this one. Generally, yes, because many times the buyer's perspective is return on investment. How soon can I get to break even and actually start making money on this investment? Going back to the 1 + 1 = 2 and 1 + 1 = 2.5 analogy earlier in the presentation, because the strategic buyer's return on investment is faster, consolidation of overheads, cross-selling between customer lists, consolidation of supply chains and distribution channels. All of these things become far more accretive to the earnings of the business, allowing the strategic buyer to pay more than a financial buyer. So that being said, we ideally would like to see everybody buy strategically within their space and be able to get a quicker and better ROI. But definitely strategic.
Great, thank you. And to stay within our hour for everybody, thank you guys for all your expertise and knowledge in this. Thank you everybody for joining us today on this topic. Feel free to reach out to us anytime with questions on the material today, but reach out on any other challenges you are facing. You can find Mark, Alan, myself, Next Point, Tony Segura and Associates on LinkedIn. Follow us to get continual updates on future webinar topics. Mark and Alan's contact information are on the screen for you. And it looks like we do have one more question that popped in. Assuming maybe this is for you, Alan. Is there a list of companies for sale?
Different houses do it different ways. A brokerage house will have an inventory list. We are a strategic M&A house. The other side of it, we actually look for targets specifically to your spec sheet. By going through the process, we're trying to create exactly what we've talked about, a strategic advantage in the acquisition. Brokerage houses, just like real estate brokers, don't do the strategic target search and acquisition model that we've talked about today, but they'll list the businesses for sale in sort of an inventory fashion. We don't do any kind of price determination on buyer or sell side. The market will decide on the price of the buyer and the sell side.
Yeah, I think what happens to, particularly for, private or public companies, but private in particular, they're private.
Mm-hmm.
So, by nature, and certainly public companies will probably not announce that they're up for sale either. But, that's so it's really going through that strategic process, right?
Right.
And a lot of times what I'll say too is that some companies don't know that they're a seller, right? And I find sometimes that we have an active buyer who all of a sudden approaches a target, and target says, well, we're not up for sale, but we're interested in buying you. Right. And so there's unsuspected, buyers become unsuspected sellers.
Confidentiality of the buy and sell side is usually paramount to many businesses. So a listing becomes complicated at that level. And I agree with Mark's points completely.
Great. Well, thank you again, guys. Thank you, everybody, for joining us today. And we'll have some more webinars coming up in the coming months. So stay tuned for emails on that. And thank you for joining us and have a great afternoon.
Thank you.